Omair, let me just first ask you about if we can ignore the 20, well, I won't even assume that. Let me ask you what you think is more important, the 20,000 disappointment on the payroll side or the strong wages, strong unemployment numbers?
Yeah, quite honestly, when that number came out, it was pretty shocking. I thought they'd just forgotten a zero and it meant to be 200. But when you go through it, I would ignore the 20,000 for right now. The 3-month trend is 185. We got an upward revision to both Dec and Jan, right?
Meaning December and January.
Exactly,
yes.
Yeah, December and January both revised upwards. Again, the underlying trend is good. And by the way, nothing corroborates a slowdown to 20,000. Jobless claims, 60-year lows. We've got good employment data on the ISM. So I think everything else is saying the labor market's still pretty good. This looks like a weather effect to some extent on February. So I would put that aside for right now.
Do you agree, Mike? I mean, when the markets are, I totally get why there'd be a knee-jerk reaction to sell stocks on the news and for the 10-year yield to fall. But when you look through it, I mean, the fact that, look, even if it's a one-month aberration, to have the wage growth at 3.4% seemed unheard of just a year ago. And is this thing going to keep going higher?
Well, it's interesting because Omair would be better to talk about this, but the average weekly earnings was up, but not as much, right? So 3.1, so there was a shorter work week. So in other words, the math of it is good and it's a good trend, but I also think that there's a benefit of not having the market somehow think that this is going to be a Fed catalyst. In other words, they're going to have to worry about inflation. So it was a fine number because of the context. I agree with the revisions. I mean, it seems a little bit more of a one-off, but also the market was already in this defensive crouch a little bit. It's already been kind of marinating in this global slowdown talk for a while. That's why the bond market did not have a bigger drop in yields, as Rick was saying.
And I think what he's mentioned about Mario Draghi, what Rick said, Omair, is, I mean, super important. Obviously, it's a terrible situation over there. They're trying to turn to bank loans to stimulate things again. And I don't know if the prognosis looks that good. So does that come back to the U.S. or can we keep seeing the kind of labor market growth that we've seen no matter if the external economies are strong or weak or somewhere in between?
Yeah, look, I think when you look at what the Fed did, it's looking better and better every day in terms of being patient. These cross currents, whether it's Europe, whether it's the news out of China most recently, all these cross currents, they're worried about sort of the blowback on the U.S. economy, and that's why the Fed paused. And it's looking like a good decision in retrospect. But I think the labor market can continue to grow. I mean, we have more job openings right now than we have the number of unemployed people. So that alone tells you labor demand is still out there. People still want to try to hire, and I think we can continue to see that going forward.
The market, I think, has been struggling with this idea of exactly how much more it can feed off of the Fed being correct to become patient. And that's why I think you go up 19% in 10 weeks. We're down, 2.5% in the S&P in a week off of that high. It doesn't seem as if it's really a panic, but it's still this sort of wait-and-see question for the markets at these valuation levels. We really want confirmation that the U.S. economy is going to be resilient and drive maybe a bottoming in earnings estimates.
Last thing, Omair, which hopefully I can spit out with the frog in my throat. But what are we going to get to the point this year where the unemployment rate is lower than the average hourly earnings year-on-year growth? Is that inflection point coming? Because they're very close right now.
Yeah, I think it's very possible. I mean, the unemployment rate ticked down to 3.8 today. There's a decent chance we could be down to 3.5 by the end of the year, especially if the participation rate kind of holds or maybe even dips a little bit. And wage growth has, as you mentioned, it's really been jumping the last 6 months in particular. We've moved up quite sharply. So yeah, it can go. But to the earlier point, it doesn't necessarily mean, and Jay Powell's been harping on this, doesn't mean that inflation's around the corner.